Wesley Boudreaux, one of our senior financial advisors here, will be on in just a second to offer his insights on proven strategies to help you navigate volatile markets and fine-tune your portfolio. But before he comes on, I'd like to quickly welcome you first and foremost to one of our Fortune 500 focused webinars here at the Retirement Group. I'm Sam, and I'll be your moderator today. If you stick around after his presentation, Wesley will also be answering some of your questions. Feel free to pop open that Q&A box, ask away. It's completely anonymous, and we welcome your participation. I'll also be entering some links throughout the presentation. Feel free to pop open that chat box as well. There will be several links in there that you should take advantage of. One will be for the complimentary cash flow analysis that you can have run with one of our advisors to get started on your retirement planning. Another may be a link to simply speak to one of our advisors about your specific concerns or situation. And I should lastly just remind you that we are not affiliated nor endorsed whatsoever by any specific company, though we have many clients from several Fortune 500 companies. The Retirement Group is not affiliated nor endorsed by any specific company, so please keep that in mind as you're listening along with Wesley today. And without further ado, here is Wesley Boudreaux. Hey, Wesley.
Thank you. Yeah, thank you for the introduction, Samantha. Like she said, we're going to be talking about some different economic conditions, some things like that really matter to everybody's portfolio, whether you're one of those companies we do work with or not. But let's kind of jump right into it and talk about preparing for market volatility, talk about strategic investment practices, and we'll kind of recap some of this and talk about who the Retirement Group is here at the end. So first and foremost, we need to understand the impact of economic situations and how it could affect your specific portfolio. That could be from a number of different items, whether it be global crisis, whether it be geopolitical risk, whether it be domestic political risk, whether it be the Fed tightening or easing monetary policy, interest rates going up, going down, different sectors getting disrupted, a pandemic. There can be a number of different things that we need to be aware of and how it actually goes into what your overall investment strategy is. Now, generally speaking, the farther out you are from retirement, the more you can withstand some of these, the closer to retirement you are, or in retirement, which is where most of our clients are, then it's going to be more of a situation where some of these can have a big drastic effect on your overall long-term goals. So it's very important to understand those and how they potentially fit into the mix. And so it's good to do different scenario testing to see hypothetically how some of these would actually disrupt potentially your portfolio. So it's also really important to stay informed and understand what's happening and what could happen. Doesn't mean you need to jump ship or make changes every time you see something drastic happen, because let's face it, today we see a lot of drastic things happening in this world left and right all the time. So as far as coming from what we could be looking at, we just need to understand how those could affect us in the short term. In the long term, we'll talk a little bit more about how long term makes more sense for the strategic investment process for most of you. So the long term, I just mentioned, is playing the long game is something we need to focus on. We need to emphasize on long-term goals over short-term market movements or market reactions, if you would. So a lot of times what we want to do is we want to stay the course. It's about time in the market, not timing the market. Because if you miss some of the best days in the market, you can actually see a severe drop in your overall performance. And if you try and time the market, you got to get it right twice. You got to know when to get out and when to get back in. And I can speak to this from experience, having worked through a couple of bear markets and having clients back in the 2008 crisis, actually go all to cash. And I think it was September or so, just before we started having that major decline in October 2008. And we looked like geniuses at the front side, but on the back side, it took them 2 years to get back into the market. So we missed all that rebound. It wasn't from me not telling them, starting February, March, trying to get them back in, but they made it right on one side, but didn't make it right on the second side, and return actually underperformed compared to where they would have been just simply staying in the course, staying in the market. So again, it's also important to diversify that portfolio. We'll talk a little bit later about different asset classes and how they kind of ebbs and flows throughout the course of history, and not one side, assuming not one asset class that is the best every single year going forward. But you need to understand that and how those kind of factor into market swings as well. And ultimately speaking, as far as, I mentioned before, missing some of those best days in the market, if you just simply missed, actually, let me go back and we look at the last 30 years or so in this chart here. I probably need my glasses on to see a little better, but from memory, you've got over the last 30 years or so, if you about half of the best days in the market actually came during a bear market. So again, that's that rebound happening during a bear market in some cases. And the next, I think it was 28% or so, those actually came the first couple of months going into a bull market. So if we look at this, only about 22% of the best days over the last 30 years or so, out of 50, excuse me, out of the last 30 years or so, actually came during the long-term bull market. So when we're used to kind of that market continue to go up and up and up, that gradually happens. But when we have a correction, then we tend to see a spike in those rebounds. Remember, if a market comes down, it's got to come up that plus more in order to recoup those losses. So again, if you got out of the market during, let's say you saw the market starting to decline and it caused you to panic, you got out of it and you missed those rebounds. A lot of times people tend to stay on the sideline until it's too late. They're not too late, but until they've missed some of those great rebounds. And kind of looking at this as far as, real money, if we look on that right-hand side of this chart, if you just miss the best 10 days of the market, it's about a 50% drop. And if you miss the best 30 days over the last 30 years, it's actually about an 80 some odd percent reduction in what your actual performance would have been. So one of the things you need to be prepared for, again, are setbacks. There are setbacks throughout the course of history and probably throughout the course of your savings time frame and potentially your retirement time frame, because hopefully you started early and you've got 60 some odd years of investment ahead of you, whether it be maybe 30 years during working and another 30 years in retirement or so. But volatility is something that will rear its ugly head from time to time. You need to be prepared for that. And one of the best ways to be prepared is just simply having an emergency fund, making sure you've got your assets set aside to cover what you need in an environment where there could be some risk, whether that be the pandemic, whether it be liquidity risk in the market or the ability to tap into your account, whether it be a severe drop in your account and not wanting to tap into that and realize those potential losses. We have seen, I'm not going to say this is going to be the continuation going forward, but the last couple bear markets, they've gotten quicker and quicker, the rebounds of those. So again, if you panic, pull your money out in order to survive, then that money is guaranteed that loss and you're outside of the market, so you don't get that potential rebound there as well. So this could be, usually we want to say at least 3 months of essential expenses set aside. A lot of times we prefer you to say 6 months or so. And for our retirees, we tend to structure our plans around that, making sure that we've got sufficient assets to cover their essential expenses for the next 3 to 6 months, if not more, if they're more conservative. And then we've got a structured plan that's going to be conservative for the shorter term, and then more maybe a more balanced approach for the long term. Another item to be aware of, not necessarily, we use sometimes insurance in the financial industry for maybe protecting your assets, maybe set up a guaranteed income stream, or maybe a life insurance used for long-term care multiplier, so you can make sure you insure yourself there. But even outside of that, just insure against catastrophes, whether it be homeowner's policy, God forbid there's a fire or a hurricane or earthquake. You want to soften the blow that could have on you. Car insurance, if you get in a wreck, that can be quite expensive. So you want to make sure you have insurance to cover that. Short-term disability, we talked about long-term care. And one of the biggest ones for those of us that are younger, have got families to support and don't have the assets set aside to support them yet, we need to make sure we review our life insurance. Like, God forbid something happens to me, I want to make sure that my wife and kids are taken care of and they don't skip a beat. And so a lot of times that's going to be life insurance earlier in your career. Later on, you may be self-insured, and we can go through that with you one-on-one. So ultimately, in order to do this is stuff you can do on your own, but it gets a little bit more complicated. We do suggest seeking advice. Let's face it, I'm a big DIY guy, but I'll go out there, I'll tackle building, a backyard project, playhouse or something like that for the kids. But do I want to go out and build an entire house on my own? No, I'm going to hire experts that have done this countless times and understand the ins and outs of building that house and making sure that it's a structure that does support me. So same thing with retirement. You want to make sure that you build that portfolio so that it supports your specific goals. So we do believe that there's a value in consulting with advisors. Even if you don't do business with us, we'll talk about this a little bit later, but we do provide a complimentary cash flow analysis or a financial plan, which is really a great way to actually back into what are my goals? What do I need to meet in order to achieve my retirement goals? So at least just take us up on that. Or if you have a question or want to review your portfolio, we can provide all those complimentary, then dig into the different aspects of where we can help you in the next steps as well. You do want to tend to adopt a set it, forget it mentality sometimes. Not going to say that put your head in the sand and don't do anything, but especially if you've got a longer time horizon, maybe you've got 10, 15, 20 years before retirement. A lot of times, some of the best portfolios we've seen as we talk to people right around the corner from retirement are those that didn't do anything. they started their 401k and they just kind of kept plowing away and working, making their contributions. And lo and behold, toward the end of their career, they built up a pretty nice nest egg, especially those that have pensions as well. That's a definite help there as well. But ultimately, that long-term aspect is going to be a beneficial option for you. But you do want to go ahead and update your risk tolerance and update your plan from time to time. So again, somebody in their 40s, generally speaking, if we're just talking about age, is going to be able to withstand a little bit more risk than somebody who's maybe in their 60s or 70s and is closer to needing that money and pulling that money out. Now, again, I say this from an average standpoint, because I've got a lot of clients that are still aggressive and can be aggressive in their later years because they built up enough of a nest egg and they're focused on maybe splitting their goals. Maybe they're having a goal to generate income for one portion of their portfolio and another to generate a legacy for their kids and pass that on. So again, you got to make sure you understand those goals associated there. Now, we talk about having the help of somebody, an advisory firm like the retirement group or somewhere else to kind of steer that ship for you or quarterback your financial situation. There's a Dalbar study that's been going around for over 30 years or so, but we'll take a look at this one about 30 years back or so through 2022. But this kind of shows you what the average investor consistently does compared to just staying the course and staying in the S&P 500. You can see that over the last 30 years or so, the average investors returned about 6.81% versus the market about 9.65%. Now that's about a 70% participation, if you would. And they run this by looking at the individual portfolios and the timing aspects of individuals, where they take money in, they go in, go out of the market versus just stay in the course. Going back to where I mentioned before, missing some of the best days in the market, kind of this captures that as well. But typically speaking, a DIY person on average is going to do about 70% of what the market does, just simply stay in the course. And to kind of extrapolate that into real numbers, if you look at, if you had $100,000 invested back at the beginning of this, I think it's 92 or 93 on this chart. You would have, even though you got 70% of the market return, you got less than half of the actual dollar amount return. You can see you got about $721,000 versus 1.5 million and change there. So again, it's very important to understand this. Another aspect of employing the help of an advisory firm is it's not just about the investments, it's about keeping that money too. So there's a lot of focus on tax planning strategies to make sure you keep what you have, but ultimately it's there to kind of make sure you stick to your guns and understand your goals and your risk tolerance in that portfolio structure. So as far as the portfolio structure is concerned, we want to make sure that we do rebalance that portfolio periodically. Otherwise, if we don't, the market will do it for you. So you want to align your portfolio with what your risk and your goals are. And like I mentioned before, a lot of times you may just simply say, hey, I want to grow this portfolio, or you may say, I want to protect it. And those change throughout the course of your life. Usually, again, it's good to have a deeper understanding of what your goals are first to back into what you need to achieve. But let's say if you were looking at a portfolio you structured in a balanced approach, maybe a 60-40. If you did nothing, did not rebalance that, every year or 2 years or even every half year or so, and we assume just a general normal market situation where we have a kind of a slow bull market where stocks tend to outperform bonds, and you let that go for a couple of years, that 60-40 is going to slowly turn into a 65-35 or a 70-30 or maybe even a 75-25%. So fast forward, when we do have another bear market, which it's inevitable, we will eventually. Now you got 75% exposure to the market, so you've got that extra 15% or so exposed, in which case you're going to suffer a bigger loss. And what's going to happen is the market's just going to rebalance it for you, get you right back in that 60-40 alignment. So it is important to stay on top of that and kind of balance that every step of the way and review that, making sure that you get into there. But that's just sticking to the asset allocation. There's also tactical shifts and tactical allocations that we would talk with you about as well. By no means do you want to time the market, get in or get out, but there are times where you may want to increase or decrease your exposure to different areas of the market, or maybe you want to reduce your stock holdings because you're getting closer to changing your allocation, or maybe you just have fears of the market, the market's overvalued. A good example would be going back to early 2020, before the pandemic, or before we knew about the pandemic. A lot of our portfolios, we reduced a little bit of risk because not because we knew the pandemic was around the corner, but because the market was overvalued at that point, and it made sense to take some of that off the table. There wasn't anything worth buying at that time, and lo and behold, it worked out well, because a month or two later we started to see the decline from the pandemic. But that also meant we had some cash on hand or some bonds on hand to redeploy early March near the bottom, so we could rebound a little bit more going forward. So it is important to understand these. You got to maintain that balanced perspective and understand truly what your goals are and your investment philosophy, because let's face it, we have no idea what's the best performing sector or allocation model from year to year. This Callan chart's pretty busy. I'm not going to zoom in and give it to you, but it looks really like the periodic tables. And it's really what it is. It's showing you about 10 different asset classes and how they perform differently over the last 20 years or so. And the one thing I'll have you notice is there's not one color that's at the very top every single year. So what may be the best performer this year may be the worst performer next year, or there may be one that's kind of consistently averaged through there, or you pick the one that you like and you could see it going up and down throughout the course of that chart. But it's really important to understand the different risk associated with those and be fully diversified. Now, a lot of times within your 401ks, there are limitations on what you can diversify through, unless you've got a brokerage link or if you have the ability to roll over to an IRA. Even during work, some companies let you roll over to an IRA, at least a portion of your account. But after you retire, you can roll to an IRA, and then you've got countless choices in there available for you. So ultimately, kind of recap a lot of this. Again, this is high level, but we want to make sure we stress the significance of staying calm and sticking to your plan. Again, this leads into running that plan, figuring out what is it that I need to achieve to retire. You may run the numbers and realize, oh my gosh, I've got enough money set aside. I can retire early. Or you can say, I need to actually work longer. And the question becomes, do I want to take on more risk or work longer? Or you may be in a great point where you saved enough where you have the luxury of being conservative, middle of the road, or aggressive, depending upon what your goal is. In some cases, we may want to split those goals. And that gets into kind of a buckets of money strategy, but there's a lot of different options to review. There's no one size fits all. And the key to navigating the market uncertainty is preparation and strategic investment practices and a balanced perspective. We kind of talked about this. Again, a lot of times employing the help of an advisory firm can help you kind of weed through some of those sources and help you determine the best asset allocation for your specific goals, and then staying the course and making sure that that asset allocation continues to meet your goals, and making sure that we rebalance it and maybe we have some minor shifts here and there for tactical allocations along the way. Now, I alluded to it a couple of times throughout the course of this webinar, but ultimately, one of the best things you can take us up on is our complementary cash flow analysis. This is really a financial plan. About 3/4 of Americans over 50 don't have a written plan. If you can spend anywhere from 10 to 30 minutes with us gathering some data points, we can put that plan together, have it ready for you in about a week's time or so, and sit down with you and go through that one-on-one to show you exactly where you fall. Whether you're 10 years out for retirement, 5 years out, 20 years out, maybe you're 5 years into retirement. But we can find out, okay, how much money do you need to set aside or save in order to meet those specific goals? Should those goals be changed? And then once we know what your plan is, what you're trying to achieve, then we can back into the actual numbers and help you on your 401k or your IRA and figure out, hey, are you in the right allocation right now for those goals? Can you increase it, decrease it? Should you compartmentalize it? Look at some different split strategies. We can go through all those different options with you. But a quick reminder who the retirement group is. Again, we are an independent financial advisory firm that does work with employees from Fortune 500 companies that are either retiring or already retired. A lot of our advisors, myself included, work with just a select few companies. The reason we do that is because it allows us to have more expertise in your specific company plans. So we can cover questions from the pension, the 401k, healthcare retiree medical benefits, life insurance continuation, things like that. So we know that we can run through there and tell you, okay, by running this plan, are you on the right path for retirement? Can you retire? When should you retire so you maximize those benefits? We go through all those different options with you. We do have offices throughout the country, so rest assured if you need to sit down with somebody face-to-face, we can likely accommodate that. But obviously this day and age, there's a lot of web meetings going on, and we can communicate that way, or phone call or email, and just let us know what your preferred method is. And like I said before, that cash flow analysis is something that's complementary. So you might as well at least take us up on that to see where you stand, to then back into what an appropriate investment strategy would be for your specific situation. Because again, we're all different here. At the end of the day, I got a couple QR codes up here. I'll leave up once Samantha comes back on to see if there's any questions, but you can use those to get into our LinkedIn account to follow along with us there, or get more company specific information for your company plans. There's one to schedule an appointment with myself or one of the other advisors in the retirement group offices. You can get into our calendars and set something up to meet with us there. You can reach that info@theretirementgroup.com if you just got a question you want to return. And you can also call us at 800-900-5867.
Thank you, Wesley. And yes, as a reminder, the QR codes that Wesley has up, there are also some links in the chat you can take advantage of. If you are not able to click on those QR codes for any reason, use the links in the chat. Alrighty, Wesley, are you ready for some questions?
Sure.
Alrighty. First question. I have $500,000 in my 401k. How can I use asset allocation to protect against market volatility?
Okay. Well, good job on saving that. It's all going to depend upon, really a deeper part of the question, kind of who you are, where you are in your retirement career. So obviously you want to look at protection of somebody who's done a great job and saved this in their 40s. That's great. You've probably got more years ahead of you before you retire, I would expect. But somebody who's maybe in their 50s about to retire and needs that money might want to be more conservative. So that goes into that asset allocation. We talked about it on a high level, but generally speaking, asset allocation is that diversification between stocks, bonds, money markets. We can get more technical in there in various sectors, real estate, alternatives, and things like that. But for most of the 401ks, simply put, you're usually looking at stocks, bonds versus cash. So obviously, somebody wants to protect themselves more in their 401k. It would be looking at adding more bond exposure, which it's going to depend. It's best to give us a call because a lot of 401ks we work with, excuse me, actually also have what's called a stable value fund in there. It's a GIC, a guaranteed insurance contract. It's like a money market, but usually pays more. So a lot of times we're going to recommend maybe a split between bonds and that because you have a higher guaranteed yield there. But at this point in the market, we're finally hopefully moving back towards the norms we've had. We're coming out of that bull market of bonds having the interest rates been driven so low, they're getting higher again now. So you're getting good yield on those. So generally speaking, the 401k, it's introducing bonds and maybe some cash into that portfolio. But again, it's important to give us a call to look at that one-on-one because I have no idea how old you are or what you really are trying to achieve in this goal.
Ready. Thank you. Second question. How can I incorporate tax loss harvesting into my investment plan to reduce tax liabilities during volatile market conditions?
Okay, that's actually a great question. I kind of started this saying that we're talking about investments across the board, but I feel like I kind of honed in on 401ks because that's what we do a lot of business with, those that are retiring. So tax loss harvesting in 401k doesn't matter. Tax loss harvesting, so those of you that don't know what it is, it's the ability to kind of save taxes by harvesting your losses in a brokerage account. So let's take that same example. I think you said was $500,000. Let's assume maybe a husband and wife has saved that over time and they've got that in their brokerage account. And maybe what's happened is throughout the course of the last year or last couple of years, they've got some winners and some losers in there. And instead of just going in there and having the taxes continue to generate off of that because of the capital gains or dividends getting paid out, they might go in there and say, okay, look, I've got $20,000 worth of losses in these accounts that some that I bad picks or maybe just hasn't gone well, and I don't like those anymore. But or I don't like those anymore, but I do like the sector and I want to make sure I'm in there. So I might have fund ABC that's got a $10,000 loss. I'll sell that. I will harvest that loss to offset any other gains I may have for the year. But I may go back and actually buy fund XYZ, which really does the exact same thing as fund ABC. Now you can't do that with a specific stock and go from one to the other. So you can't sell Tesla and buy Tesla back. You have to wait 30 days to do something like that. But if we're talking about ETFs or funds, there's usually multiple choices that do the exact same thing as what your one is. So if you have more questions on that, give us a call because it can get more complicated. You want to make sure that the tail doesn't wag the dog. You don't want to use taxes as an overall decision making tool. You still want to look at the overall investment strategy there. But generally speaking, selling losses, harvesting them to offset your gains in current years. Now, if you don't offset all of them in the current year, you can carry forward $3,000 to your income taxes and then carry forward that loss against others in the future.
All righty, Wesley, we're going to just do one more. How can I strike a balance between protecting my retirement savings and generating sufficient returns in today's uncertain market?
Okay, there's a number of different ways, not a one size fits all. We kind of talked, that first question was getting in on asset allocation and looking at maybe adding some more bonds to the mix to become more conservative. In a 401k where you may have limitations, the answer might just be that same situation. But if you were in an IRA where you've got maybe more choices, it may be an aspect of maybe you run the review and you realize, okay, I got Social Security to cover, let's say 60% of my essential expenses. So maybe you want to take a portion of your portfolio and guarantee that, where you're looking at either getting into fixed rate instruments, or maybe you're looking at generating your own pension, if you would, getting an annuity, so it's guaranteed for the rest of your life, or a portion of that. That's going to soften the blow, reduce what you have to take out from your other accounts, so you can actually be more aggressive or be more balanced if you want to. Or it could be a buckets of money strategy where you say, okay, we talked about having the emergency fund for 3-6 months or more. And maybe that you say, okay, well, I want an emergency fund for the first 6 months of expenses in case something happens. Then I want to make sure my next 3 years are covered by something that's more conservative, maybe an ultra short term conservative portfolio. And then the rest, I can let that be in a balanced approach or let it grow, because I know that if we have a bad market scenario, that my next 3 years or maybe 3 or 6 months is going to continue to come to me. It's not going to be affected. So that's going to allow me to weather the storm and not have a knee-jerk reaction and start selling everything. Whereas if you had everything into one specific basket, it may be hard to differentiate those. You may just start selling in a bear market, which depending upon the time you do that, it could be detrimental to you. So a buckets of money strategy, increasing bond allocations, we're looking at maybe fixed annuities or guaranteed income streams would be some different ways to help in that situation.
All righty, Wesley, that was it. That was all we had time for today. Were there any last comments you want to make or anything before we end?
No, just as you said before, anybody has any questions, give us a call. We have worked extensively with a lot of different Fortune 500 companies. That doesn't mean we're employed by them or endorsed by them. But should you have any questions on a high level or in detail about your plans, you can reach that 800-900-5867. Thank you guys very much.
Thank you, everybody. We hope to see you on another webinar soon.